As 2025 comes to an end, the ECB faces a dangerous turning point. One pivot that could reshape the entire European market. Interest rates, inflation, bonds, everything is on the line. So what is the ECB's true endgame, and where do the risks lie? Today, let us analyze this issue. Frankfurt, Germany. The financial heart of Europe is beating, but the rhythm is irregular. As the year ends, the European Central Bank faces its most dangerous dilemma in decades. The inflation dragon has been wounded but not slain. Prices are cooling, yet risks remain. For the average European, the cost of living crisis has morphed into a standard of living crisis. But a new enemy has emerged on the horizon: economic stagnation. The engine is stalling. The ECB's strategy for the year-end is not just about rates, it is about survival. Markets are betting on cuts. The ECB preaches patience. Someone is going to be wrong. Today, we dissect the ECB's endgame. This is the year-end rate strategy explained. To understand the strategy, look at Germany. The sick man of Europe is back. Manufacturing PMI is screaming recession. High energy costs and rates are crushing the industrial base. Exports are falling. Global demand is weak. This pleads for lower interest rates immediately. However, the services sector tells a completely different story. It is surprisingly resilient. Services inflation is sticky. Unlike gas prices, wages in restaurants and hotels don't fall easily. Workers are demanding higher pay to catch up with past inflation. This scares the ECB. The hawks in the council argue, if we cut too soon, inflation flares up again like the 1970s. That is the nightmare scenario. A second wave of inflation is always harder to kill than the first. So the year-end strategy is a balancing act. Fight wages without breaking the economy. Their solution: data dependence. But specifically, they are looking at one key metric. Rates are the visible weapon, but the hidden weapon is quantitative tightening, or QT. For years, the ECB printed money to buy bonds. Now, they are letting those bonds expire. This drains liquidity from the banking system silently, increasing the cost of borrowing further. The impact is uneven. It hits debt-heavy countries like Italy harder than fiscal-prudent Germany. Monetary policy works with a lag. The pain felt today is from hikes made 18 months ago. The doves worry that combined with QT, the current rates are actually too restrictive. As inflation falls, the real rate automatically rises, tightening financial conditions without lifting a finger. This is the passive tightening effect. It's the silent killer of economic growth. So what happens in December? Analysts project three distinct scenarios. Scenario 1, the Table Mountain. Rates stay high for longer than the market expects. This is the ECB's current communication. They want to crush inflation expectations completely. The risk: they overshoot. They break the housing market and trigger a deep recession. Scenario 2, the pivot. A surprise cut or a strong signal that cuts start in Q1. Markets would rally, mortgages would become cheaper, but the euro might crash. If ECB cuts before the US Fed, the euro weakens, making imported energy more expensive again. This is the imported inflation trap. The ECB is handcuffed to the US Federal Reserve. What does this mean for your money? Volatility is guaranteed. Cash is currently king. High rates mean savings accounts finally pay real returns. Real estate in Europe will remain under pressure until the first rate cut is actually delivered. The year-end meeting isn't the end. It's the setup for a pivotal new year. To truly understand the risk, we must look at the fracture line of Europe, the Alps. In the north, Germany is suffering from an industrial heart attack. They need lower rates to stimulate investment. In the south, Italy is drowning in debt. High interest rates make servicing their massive public debt impossible. This is the spread, the difference between German and Italian borrowing costs. Watch this line carefully. If the ECB keeps rates high for too long, the spread explodes. This triggers a sovereign debt crisis. The ECB's one-size-fits-all monetary policy is currently fitting no one. They are walking a tightrope. Save Germany from recession or save Italy from bankruptcy. This structural flaw is why the year-end strategy is so cautious. One wrong move breaks the union. History has a warning. We call it the Trichet mistake of 2011. Back then, oil prices spiked. Inflation rose. The ECB panicked and raised interest rates twice. It was a fatal error. They tightened into a supply shock, causing a double-dip recession. It took Mario Draghi's, whatever it takes to save the euro from that mistake. Today, Lagarde is haunted by this ghost. Is she raising rates into a dying economy? The charts look terrifyingly similar, a supply shock followed by aggressive tightening. If history repeats, the pivot in December won't be a choice. It will be a rescue mission. But this time the ECB has a new secret weapon, the TPI. TPI stands for Transmission Protection Instrument. Think of it as a financial bazooka. It allows the ECB to do two opposite things at once: raise rates to kill inflation, while printing money to buy Italian bonds, specifically to stop them from crashing. It creates a synthetic market. The price of debt is no longer set by investors, but by Frankfurt. Legal experts call it controversial. Markets call it yield curve control in disguise. The existence of TPI gives the ECB confidence to keep rates higher for longer without fear. This is why the December meeting might be more hawkish than you think. The safety net is ready. But can a theoretical tool stop a real market panic? We might soon find out. Enough macro theory. How does this strategy impact your portfolio? Let's look at the assets. First, gold. Historically, when central banks break the economy, gold flies. It is the ultimate hedge. If the ECB pivots early, yields drop and gold targets new all-time highs. European equities DAX, CAC 40 are in a danger zone. High rates compress valuations. Specifically, avoid commercial real estate. Refinancing costs are tripling while vacancies rise. What about crypto? It loves liquidity. An ECB pivot injects liquidity, fueling Bitcoin's narrative. Currency traders beware. The euro is set to be volatile. A dovish ECB crushes the euro against the dollar. The strategy, defensive until the pivot is confirmed. Cash, gold, and high-quality bonds. The lights are burning late in Frankfurt. The architects of the euro are sweating. Their year-end decision will define the economic trajectory of 2024 and beyond. They are fighting stagnation on the left, inflation on the right, and political revolution underneath. We are witnessing a regime change in global finance. The era of free money is officially dead. Navigation requires skill. Blind optimism is not a strategy. There is a structural force keeping prices high that interest rates cannot fix: the green transition. We call it Greenflation. Moving away from cheap Russian gas to expensive renewable infrastructure is inflationary. Trillions of euros in investment create demand for copper, steel, and labor. This pushes prices up, not down. The ECB has a mandate to fight climate change, but fighting climate change fights against their inflation target. By shutting down fossil fuels before the new grid is ready, Europe created an energy supply shock. This means energy prices will remain volatile. A cold winter matters more than the ECB's deposit rate. This creates a policy paralysis. They cannot hike rates to stop the wind from not blowing. Investors must accept that the era of cheap energy is over. The baseline inflation has shifted permanently higher. Look at the demographics. Europe is turning gray. The workforce is shrinking faster than anywhere else. There are simply not enough workers. This gives labor unions unprecedented bargaining power. Retirees consume but do not produce. This is inherently inflationary for the economy. As the labor pool dries up, companies must pay higher wages just to retain staff. The wage spiral is structural. The only escape is automation. But automation requires capital, which is now expensive due to high rates. The ECB is fighting a demographic battle with monetary tools. It's a losing game. Japanification is the risk. Stagnation caused not by policy, but by biology. But the immediate danger isn't the people. It's the hidden financial giants. Commercial banks are regulated, but shadow banks, hedge funds, pension funds operate in the dark. They hold trillions in assets, and they are highly sensitive to interest rate volatility. Remember the UK pension crisis of 2022? That was a shadow banking crack caused by rising rates. If the ECB keeps rates high, these funds might be forced to fire sale assets, crashing the market. The ECB has warned about this. They have no direct control over these entities, only influence. Leverage is the enemy. When money is expensive, leverage kills. The next crisis starts here. A year-end rate mistake could trigger a liquidity freeze in the shadow sector instantly. The system is fragile. This brings us to the ultimate question regarding the target itself. Why 2%? This target was invented in New Zealand in the 1990s. It is not a law of physics. Economists are quietly debating. Is the cost of reaching 2% worth the economic destruction? In a world of war, green transition, and aging populations, 3% might be the new neutral. The ECB publicly denies this. Changing the target now would destroy their credibility. But privately, they might accept a period of high-pressure economy, higher inflation allowed. This means financial repression. Your savings lose value slowly to pay off government debts. The silent tax of inflation is the only way to deleverage Europe without default. So, the strategy is clear. Talk like a hawk but walk like a dove when things break. If you find value in this in-depth analysis, please like and share. We will release more quality analysis videos. Thank you.